So we have, an AI bubble that could burst at any moment. We have a real estate crisis brewing, and we have trade wars, and we have credit issues. So this is a very toxic cocktail.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. Today's guest suggests that for much of the past 3 years, the economy and financial markets have been boosted by a sugar-high cocktail, which includes prodigious fiscal stimulus from the government, massive AI Capex outlays from the private sector, and a wave of incremental consumer spending from the waves of millions of illegal immigrants. But now he warns that the sugar high is behind us. If true, what will the repercussions be? Well, to find out, we're fortunate to welcome to the program for the first time, Edward Dowd, founder of macroeconomics consulting and research firm Phinance Technologies. Ed, thanks so much for joining us today.
Adam, thank you for having me on. Honored to be here.
Thank you. It's a real pleasure. This is sort of one of those incredibly overdue meetings. I've had people tell me forever, I've got to get you on the program, Ed. I've known that we've sort of followed each other on X. I'm sorry it's taken so long. Totally my bad, but very appreciative that you're coming on now.
Well, it's good timing because I think we're at a crossroads in the capital markets. And had we talked a year ago, I would have been convicted, but I'm even more convicted now in what we're seeing. And it's going to be a very interesting next 6 to 12 months, in my humble opinion. So I'm glad maybe in a strange way we delayed it until now.
Okay, well, that's good. We'll call that the universe doing us a solid. All right, so let's spend the next hour digging into exactly that. Why you think the capital markets are at this crossroads, what you think is likely to happen next, and what the ripple effects of that are going to be. If we can, though, just so folks can kind of understand how you see the world, I want to ask you a question that I used to ask a lot when I was interviewing people for the first time, since I haven't interviewed you before. This would be perfect time to do it. It's an intentionally broad question, but I just think it, again, helps people sort of think how you see the world. What is your current assessment of the economy and the financial markets right now?
The financial markets and the economy, well, there's a complete disconnect between the two. The economy, the real world economy, has been in trouble for quite some time, and it's been stimulated and papered over by a couple things. One was, unfortunately, we did have some non-farm payroll numbers that seem to have magically been revised down to the tune of about 1 million or so. You can call it fraud or statistical incompetence, but that was during the election year, the Biden administration, and the numbers are coming out. They're not good. So we had non-farm payroll numbers that were let's just say wrong, and that had implications for the economy. There was a lot of
but wrong to the upside, right? They were artificially rosy.
Artificially rosy to the tune of, and this is something I learned. This is my whole career. I was in fixed income in my early career at HSBC. Then I went to the sell side, did equity research. Then went to the buy side and became a portfolio manager. So I've spanned both credit and equity markets. And my whole career, I never knew of a report called the Quarterly Census of Earnings and Wages. The
QECW?
Yeah. The QCEW.
QCEW, yeah.
Did not know what that was. And the reason why we did not know what that was is because it was like, historical data that was eventually, it's the survey of 16 million actual pay, all the employers wrapped up, and it's the actual data. The non-farm payroll number, which I've known my whole career and we trade on and we look at, is the estimate. The reason why we found out about this report, and Lacey Hunt was the one who turned me onto it, is because the disparity between the two got to the point of 7 standard deviations, which,
wow.
Which when you think about that, it indicates one of two things, or both: statistical incompetence or fraud. So you get the non-farm payroll number, gets reported. It's an estimate. It's about 600,000 firms, I think, surveyed. And then the QCEW on a very long lag, about a year later, comes along with the actual numbers. Well, they usually over time are pretty close. There's some discrepancy, but over time they're pretty close. There was one time there was a big statistical error that was during the great financial crisis, but more often than not, it's just not that big of a deal. We discovered at the end of last year, going into this year, and Lacey Hunt discovered this. We checked the work. We said, yep, that's correct. And then I think Daniel DiMartino and a bunch of other people have talked about this.
They've run with it.
Set about 1.25 million jobs over the course of 2024 to the downside. To the upside, the rosy outlook. So those just magically disappeared. So the implications of that are stark. So the credit markets traded on non-farm payroll. They don't trade on the QCEW. Mm-hmm. And so the credit markets thought the economy was better than it was. The Fed thought the economy was better than it was. And decision makers thought the economy was better than it was. And it's not. And it also was bolstered by a new economic variable that we discovered that caused us to be wrong in our economic projections. Myself and Carlos, my partner, were calling for a recession at the end of 23, beginning of 24, because that's what our traditional early cycle indicators were telling us, that it had been back tested for years. Well, we were wrong. And, a bunch of other economists were wrong, too. A lot of famous economists were calling for the same thing, and then it didn't materialize. And so we asked ourselves, had the laws of economic fundamentals changed, or was there something else? And what we discovered was there was, crisis level deficit spending going on in 23 and 24 that resulted in unprecedented government spending and spending on illegal immigration, which was a coordinated logistical effort, and a lot of it was washed through the NGOs. And we discovered a lot about the NGOs when Trump came in, and a lot of great work done by Doge. So that when you drop 10 to 20 million people into an economy, the bulk of which came in 23 and 24, that's gonna produce, and you give them money and accommodations, and you subsidize an ecosystem of NGOs that facilitate all this, to the tune of, we've estimated, between 500 billion to 1.5 trillion. That's going to support your economy. Mm-hmm. And it did. And we warned in our U.S. economic report we put out on January 1st or January 9th of this year that Trump's immigration policies and we're going to reverse all that. And also we were seeing the beginnings of a real estate problem, which started to materialize a little bit in 2022 when housing starts peaked. They've been coming down ever since. But what kept a floor on the market in terms of prices was rental properties and illegal immigrants sopping up rental demand. And that's all going the wrong way. So everything that was a tailwind in 23 and 24 is a headwind now. And what's interesting is the evidence that we are correct. We pay attention to credit markets and the signals from the credit markets. When we put out our report, one of our biggest recommendations was we see a deep, U.S. recession coming. Get out of risk assets and get into risk-free assets, government securities, T-bills, bonds, 10 years, 30 years, if you have a higher risk tolerance. The 10-year when we put out our report was 480. The 10-year is now below 4%. The Fed has already cut interest rates a couple times now, and the 3-month T-bill is now hitting a new 52-week low. We're seeing high yield credits starting to break a 4-month trend. Yep. Starting to see the regional banks rolling over. So everything we talked about is starting to have the classic knock-on feedback loop effects. And unfortunately, the government's been shut down. We think it's going to be shut down for longer. Probably the longest shutdown was 35 days. We think it goes longer than that. And we're not getting any economic data at the moment. So if the economic data was being reported, we suspect the non-farm payroll numbers would be showing a lot of weakness, and weekly claims as well. Anecdotally, we're seeing layoffs. We're seeing credit markets start to wobble. And I think one of the biggest early indicators that our thesis on illegal immigration working its way through the pipeline is appearing in the auto sector. We have 3 instances of credit just imploding. We have Tricolor, which was a subprime auto lending outfit that just went away, bankrupt. then First Brands, which is an not involved in subprime lending, but they're an aftermarkets auto dealer. I'm sure they are seeing the effects of illegal immigration going the wrong way. And then I forget what the name of the company. Prima Bend is another subprime auto dealer that's going away as well. So we're starting to see the illegal immigration have an impact. If you look at the real estate market, we've been following it closely. We put out a real estate package a couple months ago. All our indicators are rolling over: starts, construction, homes for sale, and homes sold are at a record-wide gap. Usually they track each other very closely. There's a disparity between the two of about 500,000 homes. It's getting wider. And people are saying, well, we don't have a housing shortage. Well, actually, we have a home affordability problem. And inventory keeps growing. We did have a home building boom in 2021 and 22 and 20 when the Fed unleashed monetary spigots. And the illegal immigration caused multi-tenant family housing to explode. So we've seen construction, the likes of which we haven't seen since the 70s. And that's going to be the real part of the crisis. New single-family homes are obviously in trouble, but this crisis is going to be a little different than the last one. It's going to be multi-tenant homes, structures of 5 units or more, way overbuilt. And that was built to house the illegal immigration demand, which has been stopped at the border, and now there's self-deportation. So you don't actually need to deport all these people. You just need to halt the second derivative flow for these things to sour.
Which we're doing, and we are deporting them too, and then many are self-deporting too. So it could get worse. Right? Ed, that was a really I think stellar recap of or summation of sort of how you see the world here. So first off, thank you. To a certain extent, I hear you say, all right, there's kind of several big issues going on. First off, we juiced the economy artificially. At the same time, and I imagine most of the players just sort of assumed that artificial juicing was organic and sustainable, was going to continue forever.
Correct, and that's the insidious thing about this. You got to remember, during the Biden administration, the mainstream media kind of really didn't talk about what was going on. It was an unprecedented amount of people coming into the country, and it wasn't well reported on. So business leaders really didn't know what was going on. They probably thought it was endogenous to the economy of the U.S. rather than exogenous, meaning helicoptering in a bunch of illegal immigrants and giving them stimulus.
So we were artificially juicing the economy. We were telling ourselves it was going to continue forever. Meanwhile, the data that we were looking at to measure our progress was telling us things were even better than reality. And we now have weakness in some really key parts of the economy. So we've got some issues in credit. And as we all know, credit is sort of the big gorilla, right? If the credit markets get into trouble, everything gets into trouble, the way our economy is structured. The real estate market is rolling over. You didn't mention overvaluation in financial assets, but I presume, correct me if I'm wrong, I presume you've got some valuation concerns.
Correct. We put out a piece in February that indicated that. We looked at the and they've gotten worse since February. The valuations are at a point where historically forward 10-year returns are zero.
So or negative, says John Hussman. Yeah.
That implies a ginormous drawdown between now and then, obviously.
Okay, so ginormous drawdown, meaning you're very worried about a stock market correction. And one thing you didn't mention, and I'm just curious whether this is a concern of yours or not, is a lot of these things are sort of bubblicious, right? We artificially stoked the economy. Asset prices went to levels you think could have a ginormous correction from. You didn't mention AI. How much is AI contributing to the overvaluation issue?
So if you look at the stock market right now, I think that the concentration of the SPY, which is the ETF everybody owns, and is the S&P 500, I think it's 35 to 40% is 7 to 10 stocks.
Yeah.
If you look at NVIDIA, It's a market cap approaching 4 trillion, and it's literally the same size as the whole Nikkei stock market, Japanese stock market. You know, and look, so this is the problem we have. We have a real estate crisis coming. We have trade wars. I can talk a little bit about China because that's a problem. And we have credit issues starting to rear their ugly head. And then we have a dot-com bubble-like situation, which, if you remember, the dot-com bubble was not systemic. The stock market did correct 50% over 2 years, and it caused a kind of a minor recession. So we have, you know, an AI bubble that could burst at any moment. We have a real estate crisis brewing, and we have trade wars, and we have credit issues. So this is a very toxic cocktail. And the AI bubble is obvious to, if you look all over X, a lot of smart people and a lot of people in the AI ecosystem are even calling it a bubble. So now we're at the point now where people are saying it's a bubble, but the current sentiment seems to be, well, we're in the early phases of this bubble, so it could go higher.
Yeah, it's sorry to interrupt, but you can comment on this. But I just saw a headline an hour ago saying it's in a bubble, but it's a rational bubble.
Yeah, yeah. So look, we're at the point now where the case use for AI is starting to come out. There's been a bunch of studies done that corporations looking at AI and rolling out AI projects is declining because it's not ready for prime time. I think that there's a reality versus perception problem. AI has a hallucination error rate that is unacceptable to roll out, you know, full scale. So the revenues from corporate America aren't going to be there. There's subscriber revenues, but they're so de minimis that they don't even begin to cover the capex. So we've never seen an investment cycle where the capex and the revenues are so out of sync. So the return on capital, the only way to get the return on capital is for the current investors to go bankrupt, and then subsequent users of AI might get a return. But right now, you know, this capital, the depreciation schedule on these chips, and the power consumption that it needs, it's not possible. And the revenues aren't going to come, just like they didn't come in the dot-com era. They can't. I mean, the internet was a thing, and I was a tech analyst in the dot-com era. A lot of these companies went to zero. The real benefactors of the dot-com era and and it was mostly a telecom equipment and fiber build out.
Right.
That created the capacity for the companies that emerged later. Apple took advantage of that broadband. Facebook, Google IPO'd well after the dot-com crash. Microsoft benefited. So all these so all these companies that benefited from this infrastructure build out really didn't benefit from until later. And AI is an infrastructure build out that's going to be stranded. It's even worse because at least dark fiber could be used and turned on later. What do you do with an NVIDIA chip 3 years from now that what you bought for 40,000 that's worth zero? Not much.
That's a great question. I was going to ask about that. So will we have dark computational capacity, or does that expire? Right? Does it, to your point, after 3 years, is it no longer useful?
You know, well, that's assuming the madness of this, you know, constant spend goes on. There may be some use case for this, but not like dark fiber where you can just light it and turn it on. Yeah. Remember, a lot of that dark fiber was built by these people. May not remember this, but there were these companies called CLECs. Do you remember the CLECs?
Mm-hmm.
Yeah, these were a speculative telephone long distance companies that were gonna intermediate the bells.
Global Crossing, WorldCom, those guys?
Yeah, those guys, Windstar, you name it, there's a bunch of them. And they raised a bunch of capital. The financing technique back then was junk bonds. Now it's private equity. But, you know, there's always somebody willing to give money. So the junk bond market funded all these guys. They then took all that money and bought switches and fiber and telecom equipment from Nortel and Lucent and Cisco. And then one day the junk bond markets decided, hey, there's no return on capital here. And they imploded. And then Cisco, Nortel, Lucent all imploded as well.
Mm-hmm.
NVIDIA is like Cisco was to the telecom companies. And so if you think NVIDIA is going to stay a 4 trillion market cap company in a notoriously cyclical sector, I got news for you. It's going to do what all classic bubbles do. It'll go down 80 to 90% when it's all said and done.
Okay. I mean, I know that sounds unimaginable to many people, but hey, I mean, in 2022, it hit a pretty bad year, right?
So you got to remember what happened. NVIDIA was a beneficiary of the Bitcoin mining episode. And then they discovered AI. And the great news about AI is there's no Bitcoin pricing because NVIDIA, when
Right.
Bitcoin would go down, NVIDIA didn't do so well. So, but there's no pricing of AI at the moment. So this is a much better scheme for AI for NVIDIA to sell stock into. And if you look at the insiders, they're selling stock hand over fist right now.
Okay. Yeah. And Jesse Felder has been beating this drum for a long while, but certainly as we've gotten further into this year, kind of all across the corporate world, not just in the Mag 7, we're seeing higher percentages of insider selling, certainly relative to buying than like almost ever, right? So big warning sign that I think they are smelling out some of the same risks that you're seeing here, Ed. All right, so let me ask you this, Ed. The tricky part on all this, right, is obviously the timing,
Timing.
right?
Yeah.
And to your point, you said you were wrong a year ago. I think maybe you're being a little bit too hard on yourself. Maybe you were just early, right? And for the reasons you mentioned, this is taking a little bit longer to manifest. But the markets have done very well in the past year, right? And so the danger of getting out too soon, right, is that the party continues for a couple more years, right? Like the people who hopped out in 1997 because they were worried about the dot-com bust or the dot-com bubble, only to have it continue, right, for 3 more years.
Correct.
How do you gauge right now sort of what inning we're in the story?
Well, so the dot-com bubble is going to be linked to what goes on in the rest of the economy. You got to remember that a lot of people are saying that this is like 1998, 99 for, the AI bubble, but we had a different economic backdrop back then.
We did.
We had a demographic tailwind in the U.S. We had Y2K ahead of us, which was a huge capex spend.
Capex spend.
That was driven by this, what turned out to be a nothing burger of hysteria that, when the clock changes, the world was going to shut down. You had to be Y2K compliant. We
had
had
globalization where companies were totally reducing the cost of their labor.
Yeah, and we also had a deficit surplus, I believe, at the time.
Yes, a brief blip, but yes.
Yeah. So that was and the Fed was raising interest rates because the economy was so hot going into that bubble. The Fed has stopped raising interest rates a long time ago, and they're now in the process of lowering interest rates, which is never a good sign for given what people were thinking in terms of inflation. The Fed's now switched and pivoting to worrying about the labor market, and I think they understand that their numbers are wrong and they don't want to admit it yet, and they're keeping policy too tight. I think we're gonna see them chasing this down fairly soon, next 6 months. They're going to be doing
which they have in the past 50 years, pretty much every time the Fed has hiked and then plateaued, it started cutting and then realized I was too high for too long. I'm behind the curve now, and they panic cut down. Sounds like you think the same thing's going to repeat here.
Correct. And so that's why when people say, oh, we're like in 98, 99 in the AI bubble, we're already seeing, in the dot-com bubble at the end, we started seeing fantastical press releases about deals, circular deals with no details about future funding. We're seeing those now in the AI ecosystem. I mean, we're seeing OpenAI and Oracle announce Oracle stock went up 30% on some, announced. If you looked at the quarter, it was awful. The actual quarter Oracle had was awful. But the stock hit a new all-time high based on a press release. They're going to commit $500 billion to OpenAI. But if you look into the details, there's not a lot there.
Yeah, and it was crazy. I mean, that 30% was added within like an hour and after hours after they gave the earnings call, right? Like no time for anybody to vet the assumptions, right? But
Correct.
you had this massive blue chip tech company that basically gained 30% in market share in a heartbeat. Yeah.
Right. And look, if you're a student of the market, this is the kind of thing we saw in the and I was less of a student of the market, but these are what we call ending moves. When you have these ginormous, 30% rise in a market cap company the size of Oracle, it's not a beginning move.
Yep.
It's an ending move. Uh,
Late
and
stage.
yeah,
Late cycle.
late cycle, late stage. And so I think what we're going to see is we're going to see the dot-com bubble blow up at the same time the bond market and everybody else realizes we're going into a recession. And the bond market is sniffing that out. And the reason why I'm so confident is the 10-year, again, has gone from 480 to sub 4 since we put out our report. The 3-month T-bill is now hitting a new 52-week low today. The 30-year bond is put in a nice low. It looks like it wants to go, technically, if you're just a technical guy, looks like it wants to go higher in bond futures price and lower in yield. And then the US dollar, again, everyone talks about this. We just discovered the debasement trade. This is what they're calling it. When it gets the name, it's over. I'm very bullish on the US dollar. There's actually a dollar liquidity shortage going on globally. And you're going to see the dollar. We think, I have a friend, Tim Wood, he does a lot of cycle analysis, and he's discovered what's called a 4-year cycle to the dollar. And we think there might have been a 4-year cycle low in the dollar in September. And if that's correct, we got a lot of room to run higher, and it held above right on its trend line. And if you look at the long-term chart of the dollar, since the great financial crisis, it's been in a bull market. It's been up and down quite a bit, but it's a long-term rising trend. And a lot of people don't understand, what the dollar is. We're a debt-based fiat system, and we're the reserve currency. So when the dollar is declining, that means more credit's being created. And when the dollar is rising, in general, not always, but in general, when the dollar is rising, there's less credit being created. There's a scramble for dollars, and there's also potentially defaults coming on the horizon. So that's what I see. I see the early signs that there's going to be an aha moment in the capital markets, and we're going to see everybody that's on the wrong side of asset allocation scramble to the other side. And you're already seeing it in the bond market. I mean, you got to remember, about 6 months ago, our yields were going to go to 8%. That was the chatter. They're not going to 8%. They seem to be creeping lower. And why? That's because the bond market has started to focus, rather than on inflation, to disinflation or deflation.
Deflation. Yeah. Okay. So you think then, sounds like we're going to have disinflation. This was one of my next questions for you. Disinflation, deflation, not higher inflation, and then lower bond yields, obviously, along with that.
Yeah, correct. And the other thing that's misunderstood, and my partner Carlos and I put out a piece on this in April when the Trump tariffs came out. Everybody was, even the Fed, they were talking about how inflationary these tariffs are going to be. They're actually deflationary. And when I talked to my friend Dr. Lacey Hunt about it, he agreed. He put out a great piece on it too. So they're actually deflationary if you look at them on a microeconomic level. The Fed is behind the 8 ball in providing liquidity because there's one of the mistakes in the Great Depression was we had tariffs and they should have flooded the system with liquidity. They didn't, and we didn't get out of the Depression until World War II. The Fed's making the same mistake. We think eventually they will catch up. Then we got China. Now we're going to be putting out a big, huge, very sophisticated report on China that's going to be sold to institutional investors. It's not going to be cheap. So if you're a retail person, it's not for you. We've discovered that China, a lot of interesting things about China that are not really well understood. Their GDP as a percent of the US going into the COVID era was 80% of US. So everyone was talking about them overtaking us, and that's priced in US dollars. Since COVID, and by the way, coincidentally, they hit a demographic wall in 2020, and it's accelerating a lot lower as we speak. It's devastating. Their GDP priced in US dollars is 60% of the US now. And their actual GDP growth since COVID has been 0 priced in US dollars, 5% in.
Wow.
Yeah. So
What a change from the pre-COVID.
Yeah. So what happened? They hit a demographic wall. It's in our report. The numbers are different. Their internal demand is collapsing. They have a brewing real estate crisis. And to get themselves out of this, they've been accelerating their exports, hence why we have trade wars right now.
Yep.
And the message I want to send, if anybody from the Trump administration is listening, we have way more leverage than we think, because they are about to enter the acute phase of their real estate crisis that is going to require them to even export more to keep the lights on of all their industrial capacity. Because the real estate crisis had a lot of long-lived projects.
Mm-hmm.
So construction's only down 10 to 15% from its highs, but there's no new contracts being filled into the pipeline. We think that's and it's already started to decelerate. We think that's going to be a crisis level event for them in 2026. So we have a deflationary giant known as China that's going to be exporting all sorts of cheap goods. And unless we come to some sort of reasonable trade deal, it's going to be a big problem for China and for us. And commodity producing countries are going to have big problems. And I find it curious that Argentina needs 20 billion in US dollars. Why do they need the 20 billion? Their biggest trade partner is China. And China is obviously probably slowing, so they have a dollar liquidity issue. South Korea raised their hand recently and said, we want some dollars too. Who's South Korea's biggest trade partner? China. So this is going to be a problem for emerging economies, and it's going to start out. We already have our own issues, but this is going to be a synchronized global problem. And and real estate globally is going to be a problem.
So essentially, they'll be exporting to a certain extent disinflation and deflation to the rest of the world during this. You're correct?
Yeah, correct. And if you look at the price of oil, copper has its own issues at the moment. We expect copper to eventually figure this out. But oil is telling you that China's collapsed internally because a lot of the growth, in China happened in the early 2000s. And that's when oil started to really spike. Mm-hmm. Oil's telling you that the Chinese economy is problematic and global demand for oil is problematic. So oil is a very big canary in the coal mine. And in our U.S. economic report that we put out in January, we said that we would eventually see the price of oil at 30. When we put out the report, oil was 77. It's now 57, 56, on its way to 30, we think. Now, it won't stay at 30, but that's where it's going.
Wow. Okay. This is a side. I hate to say this, but I'd actually love to see that. I know it's going to have a lot of issues in the world, but oil is looking increasingly attractive to me as a long-term investment. And boy, would I love to get into these oil-related investments during $37 oil.
That'll be the time to go all in to the oil companies because it's classic. The biggest the way to correct high oil prices are high oil prices themselves, and the same with low oil prices, because you know how this works. When there's high oil prices, they overbuild and drill more, and there's too much capex, and that creates the next bust. And in the bust, they underinvest, and that creates the next boom. So at $30 oil, 20, whatever it is, it won't stay there for long, and the new boom will begin from there. And if you're a value guy, energy companies will be your friend as long as they don't go bankrupt.
All right. So when the time comes to invest in them, Ed, I want you to come back on. We'll both put on our cowboy hats and we'll channel our best techs in oil.
Yeah. And what we hope to do, we're not calling for a systemic banking crisis yet. I mean, we hope there isn't one. But this is going to cause, at minimum, we think a 50% drawdown in stock markets. We hope to come back to you and others when everybody is running around like chickens with their heads cut off. We'll be flipping positive.
Mm-hmm. I mean, look, I can't wait for the day where you and the many other folks that come on this channel who share similar concerns get to that point. Look, I like to tell people who say, oh, you're just all a bunch of doomers. It's like, no, we're just, these are data-driven analysts. We're pragmatists. And I know individually, every one of them would much rather be bullish. And so we can't wait for the day we genuinely feel like there are good values out there.
Exactly. And, look, we're not doomers. in our reports, we're not calling for a systemic crisis. We're not saying it's the end of the world. We're not calling for the end of the dollar reserve system. This is classic cycle behavior with too much Ponzi credit at the end. And it's just the nature of the beast and of the system. And it's actually, as we go through this is going to be a great thing for millennial home buyers to pick up homes finally.
Yeah.
It's for those who are cautious, it'll be a time to get in the stock market and set yourself up for retirement. So, I'm not a doomer, I'm not a gloomer, and I think a lot of good things will come out on the other side. I mean, a lot of what Trump's trying to do, he has to do what he has to do in China because it's unacceptable for China to dump their slave labor into our markets and destroy our economy. And he also needs to bring manufacturing back. But that's not an overnight success story. There's a valley in between, and it's going to take a lot of time. But long term, I'm bullish. Near term, not so much.
Okay, and I was actually going to ask specifically about that. So if the U.S. plays its cards right here, China's woes could actually really work to the U.S.'s long-term advantage here, correct?
Correct. But we also have to understand China, the current power structure needs help because the people they fear the most isn't the US, it's their own people.
It's their own people, yeah.
Yeah. So, China has two solutions. It can do what Japan did when it hit its demographic wall and their bubble imploded. They decided to export their way out. And that worked because they're a tenth the size of China. China can't do that.
Mm-hmm.
So we and other nations have to work with China to actually help them develop a consumer economy because they have a mercantilist economy right now. And so we need to raise their people up. And that's, of course, a decade-long process, and they would have to give up power to do that. So that's for them, what they're probably going to do is try to stay in power. They hope their social credit score system works, and they hope to become they already are a mercantilist nation, but they hope to become an even bigger one. That's their hope, and that's where the rubber meets the road, where President Trump and other countries are going to have to negotiate and calm them down. But China's at a crossroads, and demographically, I'm not going to get into too much details, but the numbers are horrific until 2032 demographically for them.
Yeah, I'm just going to ask this, and I promise we won't rat hole in here. But a big part of why they are where they are, right, is they've got their one-child policy that they've been pursuing for so long, right? So you end up with a ton of a kite-shaped population, a bunch of people at the top, a lot fewer at the bottom. How does it get resolved by 2032? That seems really short to me.
That's when they have a little echo boom.
Okay.
A little echo baby boom. Then it goes back to decades of despair. But there'll be a little boom.
Okay, so it's not a sustainable rescue.
No,
it's just a little relief.
It'll feel good for a couple of years, and then they're going to roll right over.
Okay. All right. So one other topic here, gold. So I heard you say there could be a ginormous correction in the stock markets. You said people, should get out of risk assets and risk on assets, get into risk off assets. But you're also very bullish on the dollar. So given those cross currents, some gold favorable, some at least historically not gold favorable, what are your thoughts on gold right now?
So about 5-6 months ago, they asked me what I thought gold was going to do, and I said I had a friend who's very good at technical analysis. He said it looked like it was around 3,000, and he said it was going to. And I knew the dollar hadn't put in its bottom yet. So I was waiting. Timing wise, we were looking for a low. I said gold could go to 4,000 according to my friend, and here we are. We're at 4,300. It gets more difficult here, and long term, I think gold is going a lot higher because there is going to be a global reordering, and there may be negotiations about what that looks like. Gold's going to be part of the discussion. Gold also became money, at least in the U.S. again on July 25th when banks were able to take physical gold and call it Tier 1 capital, which means if it's Tier 1, you can create money against it. You can originate loans against it, which is money creation.
Yeah.
So long term, I'm bullish on gold, and I don't want people to trade in and out of it, especially physical gold. I mean, if you
right.
and I recommend physical, not GLD, not these. And if you're going to do it, it's kind of it should be a part of anyone's portfolio, not all your eggs in one basket, and buy and hold and buy the dips. Gold could continue to rock here. I don't know, but if I'm a betting man, it probably goes sideways for a little bit, consolidates its gains, and then maybe starts going up again. In a ginormous systemic problem, if there was a systemic problem, there's a global margin call like there was during Lehman. Gold went down 50%, but it went back to new highs pretty quickly. So don't be leveraged in gold, because gold is you sell what you can, not what you want to. And some people were forced to sell
you
gold.
sell what has value. Yeah.
That's correct. So, but I would not get shaken out of my gold. I like it long term. The charts and the way the world's going, gold's probably going to 10,000 by 2030.
Okay. So, okay, thank you. And I just wanted to make sure. So a multi-year bull cycle in the US dollar, in your mind, does not mean gold has to suffer?
No, it does not necessarily mean that. No.
Okay. All right. Ed, this has been excellent so far. Thank you. And I got to start wrapping up because we're getting near the hour and I want to be respectful of your time. A couple questions before we get to the ending though. So one, I don't know if you specifically said this or not, but you've got concerns obviously about the economy slowing. Do you think what do you see as the recession odds for 2026?
We were calling for it in 25. It was delayed a little bit. I think the odds are I'd say 80-90% right now is my odds. When we put out a report, we were thinking it would be 2025. I think when we look back, I think when the official numbers come out, it might have started in the fourth. It might have started in the fourth quarter, but we won't know that for a year or two. But I think it's beginning.
Okay. And again, maybe the spirit of my question is, when will it really feel to folks like we're in a recession? Sounds like you have high confidence it'll be at some point in 2026. Jobs. So, again, we don't have any data right now, but the jobs data we have had has been very suspect, as you were talking about earlier. But with the numbers we have, unemployment is still relatively low. If we're having this conversation a year from now, where do you expect unemployment to be?
North of 5%, obviously.
Yeah.
Yeah. And, we did get one data point that wasn't so hot, even though the government shut down. We get the ADP number. That was not rosy.
Right.
And,
it was a contraction, right? Yeah,
it was a contraction. And the markets always focus on the NFP. And in an absence of data, the ADP becomes more important. So
yeah,
that's kind of, and the bond markets are definitely sniffing this out. And the Fed, if you listen to what Jerome Powell has said, he mentioned a couple of times immigration may be affecting employment. We said that months ago.
Right.
And then he also said we were crying foul on the NFP in 2024. He finally said that at the end of the year. There's some dispute about the non-farm payroll numbers. I think if you listen to the Fed speak, their shift to the weak labor market is telling you all you need to know. They're going to probably drop 50 at the next meeting. And if there's any kind of like credit blow up and any fast moving feedback loops, they'll drop 100. But I'm not calling that because we don't see it yet.
If they drop 50, because I don't think the market's expecting it to be 50 at the next meeting, will that freak the market out?
I think this time it will.
Okay.
There's this belief system out there that when you lower, and this is in the equity world, that when you lower interest rates, it's always universally bullish and it's free money. It's not the Fed. When the Fed lowers interest rates, they don't print money. This is not money printing. This is just a lower interest rate that works its way through the economy, usually 18 months after the effect.
The lag effect. Yeah,
it's a lag effect. And people got to remember, in 2000, the bubble peaked in March of 2000. The first Fed rate cut happened in May. Then we went down 50%.
Yep.
In the great financial crisis, they started cutting in '07, and we did go a little higher, which is what's happened here. This stock market's a bit like '07. The market's gone to new highs in the face of a couple of rate cuts, but eventually that didn't help. That didn't stop the stock market from giving up 50%.
Gravity takes over. Yeah.
Yeah. That's where we are. We're in the other side of the rate cycle. The plateau's over. We're in rate cutting mode, and it's indicating slower growth, in my humble opinion. And the AI bubble is about to burst at any moment, in my humble opinion.
Okay. I know we could talk probably an hour just about this topic in general, but on private credit, how concerned are you this cycle that we have a lot more credit in the system provided by private credit than we've had in the past, and it's because it's not regulated, we don't really know how good the quality of the loans are that have been made, and we're already beginning to see with some of the names you mentioned earlier, some negative surprises here with defaults. How big of a risk is that in this cycle this time?
Well, when the subprime crisis happened, people would always point to the dollar amount and say it's not that big, but it wasn't just. It was the feedback loops and the Jenga style credit markets we have. Our markets are built. Everything is collateralized against everything else. So once one sector goes poof, it kind of has this feedback loop effect.
Right. It's the counterparty risk. Everything's intertwined, right? Yeah.
Correct. And what the private credit markets, I think, are around 1.5 trillion total. So it's not big. The housing market's like 12 trillion. That I think that's where a lot of problems are going to occur, and we're not bullish on that. But this private credit is opaque, and it could happen fast, and there could be a lot of distrust, which is what we're seeing with Jefferies and this First Brand situation, because literally I think something over $2+ billion of this money just vanished. People say it vanished. It didn't vanish. The credit just there was no there. Just so this is the kind of thing. The subprime crisis started to emerge in February of '07, and it really didn't impact the stock market until October of '07. I think we're in a faster time frame now, so I think things are faster, and I think things are more precarious, and there's way more leverage at this time globally and in the system. So this could happen fast, but it could be delayed. I mean, just because we're seeing some wobbles in the credit market doesn't mean everything's going to float up. Right? It takes time, but there's definitely feedback loops going on.
Okay, but it sounds like you think this is just another risk factor that maybe may play more this time around than in the past, just because we haven't had this much private credit before.
Right, correct. And the other thing I'd like to explain before we wrap it up is the Trump tariff tweets and Truth Social posts.
Sure.
Tariffs are exogenous. What I mean by that is he can set them and then take them away. So that's the self-imposed pain, and he can take it away. So that's why the markets care a lot about that. What's coming is endogenous to the system. It's part of the cycle and the feedback loops. Trump can't affect that. Now Trump has a lot of control over tariffs, but the rest of the economy not so much.
Okay, that is a great point to remind people of. All right, two last questions for you. One, you've already sort of given a nod to this, but in terms of sort of what investing approach fits the current moment we're in here, right? Where the bubbles are still kind of expanding. There's a little bit of turbulence in the system here, but nothing crazy yet. We don't know how much longer it's going to go on for, although you've got a pretty good sense of where you think. I guess, is it time to be just all in risk-off assets at this point, or are there certain assets that you think or strategies that make sense here before it's time to get fully in the bunker?
Well, look, a lot of people ask me their opinion, and I say, look, it depends on your risk tolerance and where you are in your investing life cycle. If you're 25, raise some cash in your 401k and then put it in at the bottom. If you're 60, you got to be more conservative.
Yeah, the majority of the viewers on this channel are over 50. So,
well, I would say if you have leverage in the market in terms of real estate, and pay down your debt as fast as you can. If you are levered in your margin account, unlever immediately. If you are worried about if you're, have 60% of your net wealth in stocks, I would raise a generous amount of cash to reinvest at the lows. I never tell people what to do and go to 100% zero because, again, the timing is always difficult. But
Yep.
this is a time to be what I call accumulating dry powder for opportunities.
Okay. And it sounds like you think.
And people worry a lot about the U.S. dollar, and they say, "Are Treasury bills safe?" Treasury bills are the safest investment on the planet. That's not changing. Warren Buffett owns 5% of the T-bill market. If Warren Buffett's good with it, I'm good with it. You don't have to work. It's money good, and you're earning 3.9% on your T-bills if you roll them every 3 months. You're getting paid to wait.
Personally, I completely agree with you. And your point about raising cash, that's hopefully sidestep a lot of the ginormous decrease you think could happen. But your point about dry powder is, as we mentioned earlier, you expect there to be some wonderful valuations at the end of this if this follows the course you think it will, right?
Yeah, dry powder. First of all, you're not as worried as everyone else running around. Everyone else is panicking. You've decided what's comfortable for you in terms of your cash allocation versus the rest of your portfolio. And that, again, I'm not going to tell you what to do, but it depends on your risk profile. As prices come down, there's going to be wonderful buying opportunities. And I'll just use a simple example. Let's say you have $100 all in stocks and it goes down 50%. You have $50. If you're 25% cash, 75% stocks, and it goes down 50%, you have $62.50.
Mm-hmm.
That's the math.
Yep.
And then you're starting off way ahead of everybody else to reinvest.
All right. Very well explained. All right. So last question for you, Ed, and then we'll wrap it up. This is more societally. So given the policies that we've been pursuing for the past couple decades, we can argue whether they were the right or the wrong policies in the moment, but kind of the net effect has been a bifurcation of society. This K-shaped economy that you probably heard about, right?
Yeah.
And that kind of got, I think, put on steroids during COVID, right? Where the stimulus, it both juiced asset prices and it juiced the cost of living. And if you owned asset prices, your asset prices probably did much better than the rise in cost of living. So you were fine. You're doing great. Everybody else, bottom 90+%, they only got the increase in the cost of living. I'm just sort of curious to hear your thoughts about, sort of where we're headed as a society. And I'm curious too, like there'll be a lot of collateral damage to everybody if what you think is going to happen in the next year or two indeed happens. Will that be a net negative? I mean, it'll injure the bottom 80% in a way that they would very much not like to be injured. Or may it be a net positive in the fact that it's going to evaporate some of this, phantom market value that's been pumped into the markets, and it may actually decrease a little bit of the gap between the haves and the have-nots?
It will decrease the gap between the have and the have-nots, but part of the problem since the great financial crisis and zero interest rate policy for essentially 14 years is the wealth gap has grown even larger than it ever has. And historically, when we get here, there's political movements. And is there any wonder why we have populism? I mean, it's
Right.
It's this has been brewing since the Tea Party. This is
and on both ends. Sorry, but like that's what got Trump in office, but it's also what's getting Mamdani in office, right?
It's happening globally. Populism is happening globally. The wealth disparity is insane. And historically, there's two ways this ends. It ends in revolution or a new great deal. Like it happened after the Great Depression. And so I'm hoping for a new great deal, not revolution. Like we don't want a French style revolution that didn't end well,
right,
for anybody.
Yeah. I'm just curious, how much does this weigh on your mind, actively? A lot or a little or what?
I try to I have to toggle out into the future to make a lot of our prognostications, but I come back to the present moment because I was one of these people decades ago used to worry about stuff, and it caused me anxiety and mild depression. I kind of live in the present moment. understanding that life can be still very joyful, and just try to enhance my social circles and hang out with great people, but understand that the tough times are coming, but it doesn't necessarily mean it's the end of the world. It just doesn't. The sun will come up tomorrow. People will still have babies. The life goes on. It's just not the end of the world.
Well, I 1,000% agree, Ed. And look, we don't know exactly what's going to happen, and we don't know what's going to happen to us individually. And as a result of that, I tell people on this channel, look, this is a wealth building channel. We talk about money all the time, but at the end of the day, remember that money is just a means, right? It's not the end in and of itself. What really is true wealth, and I say the research is pretty clear on this. It's quality relationships, it's having purpose or meaning in your life, and it's having good health. And if you can focus on really winning in those three, be great if the money comes along, but if it doesn't, you're still kind of winning life and where it matters.
Absolutely. Absolutely. I agree 100%.
All right. Well, Ed, look, it has been a real pleasure to meet you, to be able to be in discussion with you here. I would love to have you come back on the program again whenever you want, especially whenever you are making some sort of audible change to your outlook, whether you're moving things up or pushing things back or whatever. So please know the door here is open. For folks that have really enjoyed this discussion, maybe it might be their first introduction to you. Where can they go to follow you and your work in between now and the next time you come on this channel?
No, great. Thank you. If you want to just see my public commentary, top of mind thoughts, I'm on X at Dowd Edward, D-O-W-D Edward. We put out and sell research on our firm website, financetechnologies.com, spelled with a PH instead of an F. And I also have a personal website at dowd.com where you can hit me up for personal consulting if you so wish.
Awesome. Ed, when I edit this, I will put up links on the screen or I'll put up your handle on your screen, your website URL, et cetera. And then I'll also put the links in the description below this video so folks can get there
Awesome.
direct.
Appreciate it.
Okay, well, to close up here, folks, please thank Ed for coming on today, being so prodigious and generous in terms of the insights that he shared with us. But please share your appreciation for that by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. A reminder, folks, if you did not watch Thoughtful Money's Fall Online Conference, which just happened this past weekend, which included as its keynote the great Lazy Hunt, who Ed has mentioned several times in this conversation. It was an absolutely phenomenal experience. If you are feeling a sense of regret that you missed it and didn't go, don't worry. You can still buy a replay of the entire event. To do that, just go over to thoughtfulmoney.com/conference. And if you are a premium subscriber to our Substack, you can still use that code that I've been emailing you to get an additional $50 off of the price of the replay. Last, if you would like to get some help from a professional financial advisor to position your portfolio for whatever may lie in the road ahead, but particularly if it ends up looking a lot like what Ed thinks might be happening from here, I highly recommend, again, you get that help from a good professional financial advisor, but importantly, one that takes into account the macro issues that Ed and I talked about here and that the many guests on this channel and I talk about. If you've got a good one who's doing that for you and is translating that into a good strategy and executing it for you, great. Don't mess with success. But if you don't have a good one, or you'd like a second opinion from one that meets the criteria I just mentioned, then consider scheduling a consultation with one of the financial advisors that Thoughtful Money endorses. These are the firms you see with me on this channel week after week. To set up one of those conversations, just fill out the very short form at thoughtfulmoney.com. Only takes you a couple seconds to fill out. These consultations are totally free. There's no commitments involved. It's just a service that these firms offer to be as helpful to as many people as possible. Ed, I can't thank you enough. This really has been, it's been wonderful to meet you. This has been just a fantastic inaugural appearance for you here on the channel. The door is open here at any time for you to come back and update us on your outlook. But again, really have enjoyed meeting you and look forward to seeing you again soon.
Thanks for inviting me on, Adam. I'm glad we hooked up.
And everybody else, thanks so much for watching.
I would not be surprised to see silver gap above $40. It never touched $40 in U.S. market hours on Friday. But I would not be surprised to just see silver gap above $40 and just have a big move up on Tuesday. So I would go to Shift Gold now or tomorrow and get some silver. Don't wait for that big move up, because by the time the ETF buyers have a shot, they can be looking at much higher prices. Same thing with gold. I mean, maybe gold will gap up. I'd love to see gold gap above 3,500. That would be something. That's going to be that's a bigger move, because that's about a $50 move for gold to do that. But there's so much that's going on right now, fundamentally, technically, that would support that kind of breakaway gap in these metals.
Gold hit a more than 4-month high on Monday, as increased bets for a U.S. Federal Reserve interest rate cut this month lifted bullion's allure, while silver rose above $40 per ounce for the first time in more than a decade. Peter Schiff expects a strong move higher, possibly as early as Tuesday, and advises buying silver now before prices jump, since ETF buyers might face much higher levels. The same goes for gold. If it gaps above $3,500, that would be a significant $50 move, supported by both strong fundamentals and technical momentum that could trigger a breakout. Peter Schiff, an American stockbroker, financial commentator, and author, highlights that gold appears to be entering its next big rally, likely beginning when it broke above prior highs on Friday, setting the stage for a quick move toward $3,500. As of early Asian trading on Sunday, it was around $3,448 after briefly topping $3,450. Silver also hit a 13-year high Friday, closing just shy of $40, and is now trading near $39.72. Both metals look technically and fundamentally strong, helped by a weaker dollar index, which closed below 98. The U.S. bank holiday is contributing to thinner liquidity, which is also exacerbating some of the moves in gold and silver. Silver is making a move higher in response to expectations of lower U.S. rates, while a tight supply market is helping to maintain an upward bias. Peter Schiff recalls predicting a golden age for gold during Trump's presidency, noting that while Bitcoin is being promoted as digital gold, it has underperformed, trading below its prior peak despite hype, ETFs, and official support. Gold, by contrast, is hitting record highs, far outpacing Bitcoin and stocks. They warn that Bitcoin looks like a pump-and-dump scheme and suggest converting it into gold or silver instead. Let's dive into Schiff's video for more insights. If you find the content engaging, please consider giving us a positive review and subscribing to our channel to receive the latest updates.
Gold, I think, is finally getting ready for the next leg up. In fact, it probably started that leg up on Friday by going through the highs. But now I think we've got clear sailing to get up to 3,500. I think we'll pass that relatively quickly. In fact, I'll take a look at where we're trading right now. Early Sunday evening, so Asian trading has just kind of kicked off. And in the gold market, let me pull that up. Yeah, no, gold's down about 90 cents, 3,448. A few minutes ago, it was trading above 34.50. Silver also on Friday. Silver closed at a 13-year high. We came within 10 cents of $40. Right now, we're trading at 39.72, which is up about a dime from where we closed on Friday. But both gold and silver looking very strong, technically, fundamentally. The dollar was also weak on the week. Dollar index closed back below 98, about 97.80. So weakness in the dollar also working to help the gold market. But I think there are major, fundamental stories that are going to be fueling this gold market rally. I said it on this podcast. When Donald Trump gave his first speech as president and announced the golden age in America, I said he's right in a literal sense. It was going to be a golden age for gold. And so far, gold is off to its best start probably of any presidency in history. Trump may not be making America great again, but he's making gold great again, not by intention, but the unintended consequence of his policies, right? He's trying to tout Bitcoin. Bitcoin is only up about 14% on the year, right? Gold is killing it. In fact, Bitcoin is 13% below its peak, right? Clearly, it's not digital gold. Gold's making a new record high. Bitcoin's in a correction. It could easily enter a new bear market pretty soon. And of course, the stock market is, gold stocks are crushing the returns in Bitcoin. But Bitcoin is still today about 13% lower than it was at its peak 4 years ago if you price it in gold. So despite all the hype, all the Bitcoin ETFs, the Bitcoin treasury companies, the strategic Bitcoin reserve, America being the Bitcoin capital of the world with the first Bitcoin president, Bitcoin is still lower than it was before any of that stuff happened. So how is that possible? How can all this good news and all this new buying not drive the price higher? Because there's a lot of people smarter than the people who are buying who have been selling into all the hype. This is a gigantic pump and dump that's going on with Bitcoin. And the big pumpers now are the Trump administration, and all of their friends are the dumpers. But if you're smart, you'll get rid of what Bitcoin you have, and you'll go down to Shift Gold, where we work with BitPay, and you'll take your Bitcoin and you'll buy some gold or you'll buy some silver. This is a holiday weekend, so the U.S. markets are closed on Monday. I would not be surprised to see silver gap above $40. It never touched $40 in U.S. market hours on Friday. But I would not be surprised to just see silver gap above $40 and just have a big move up on Tuesday. So I would go to Shift Gold now or tomorrow and get some silver. Don't wait for that big move up, because by the time the ETF buyers have a shot, they can be looking at much higher prices. Same thing with gold. Maybe gold will gap up. I'd love to see gold gap above 3,500. That would be something. That's going to be that's a bigger move, because that's about a $50 move for gold to do that. But there's so much that's going on right now, fundamentally, technically, that would support that kind of breakaway gap in these metals.
Peter recalls how mainstream financial media often ignored gold, even when it was making major moves. He remembers being on CNBC years ago when gold had risen about $40. To him, that attitude showed a lack of understanding, because gold isn't just a commodity, it's money. Historically, even Alan Greenspan used gold as a key measure of monetary policy, warning that high prices signaled excessive looseness. Today, with gold around $3,450, it's clear that monetary policy has been far too loose for decades. Central banks themselves treat gold as the most important asset, stockpiling it while shunning other commodities. Rising gold prices, Peter Schiff argues, are a warning sign of deep economic problems in America, yet many still dismiss it while hyping Bitcoin instead. He stresses that central banks, the insiders of the fiat system, are effectively dumping dollars in favor of gold, signaling a loss of confidence in paper money. Investors should follow their lead by shifting into gold, silver, and international value stocks, which are already seeing strong returns as money flows out of U.S. assets. Now let's dive into the interview.
They barely talked about gold, as gold was making all-time record highs. I still remember when I went on CNBC back when they still had me on. I hadn't been on like 10 years. I don't know. I can't remember when I was on. But when I used to be on every week, but when I first started going on, I was on Squawk Box, and the host was this guy, Mark Haynes, who passed away quite some time ago now. But the first time I was on, of course, I discussed the price of gold, and I think it was still below 300, or maybe it was in the low 300s. I forget. But I came back, I don't know, a few weeks later, and I'm in the studio again talking to Mark Haynes. And I said, Mark, gold's up about $40 since the last time I was in this studio. And his response to me was, who cares? Who cares about the price of gold? And, he mentioned a number of things where he cares about the price, but he says, I forget, maybe it was bread or oil, I forget. But he said, why should I care about the price of gold? Right? He is the anchor in a financial news show. It's supposed to be focusing on finance, investing, economics, And he says, who cares about the price of gold? I mean, how could you not care about the price of gold? Only if you just don't understand what gold is. I mean, gold is money. It's, you're a show about money. How could you not care about gold? And when the price of gold is going up, especially like this, it is a warning. It is telling you that there's a problem, right? I mean, even Alan Greenspan, I talked about this, he used to use gold as his primary reference to know whether or not he was too loose or too tight. He used to say that if gold gets up near 400, I'm too loose. If it goes below 300, I'm too tight. Now, what does that say? Look where we are now, 34.50. We've been too loose for decades based on Greenspan's metric. But the gold is the most important price. It's not just a precious metal. It's not just a commodity. It's a monetary metal. Central banks are holding gold for a reason, right? How could you say, oh, I don't care about the price of gold? Well, what about all these central banks that are hoarding all this gold? Don't you think that's significant? Because, they're not stockpiling other commodities. They're owning gold for a reason. It is the single most important price out there. And right now it is screaming that there is a huge problem. There is something rotten in the state of America. And that's what you're seeing in the gold market. And, I'm sure that mentality still exists today. The same one that Mark Haynes had, even though he's not around anymore. I think that idea that who cares about the price of gold, right? What's the big deal? It's nothing, right? It's just a rock, right? They care a lot more about Bitcoin than they do about gold. But if you understand what gold is saying, it is a warning. And it's a warning that you had better heed and that you better react to. You better get out of dollars. You better get into gold and silver. That's what the central banks are doing, right? Follow their lead, right? They ought to know. They're like the insiders in the fiat money system, right? So if you see in a company, if all the managers are dumping their shares, they might know something that you don't. Well, this is basically what's happening. The managers of the fiat monetary system are dumping their dollars. They want out. And they're buying gold. They're not buying other currencies. They don't want another fiat currency. They want real money. You should do the same thing. And the same thing is happening with investors. Not necessarily in gold, but they're dumping their U.S. shares and they're buying back their own stock. Right? That's why, my dividend payers fund is almost up 40% on the year now. It's at 39%. It's on the high of the year because value international dividend paying stocks, that's where people are putting their money now. That's where when they sell in their U.S. stocks and they sell their dollars, they're bringing their money home and they're buying value. They're buying income, right? They're buying these dividend paying stocks. I think we're still early in this trend.
Gold and silver are showing clear signs of entering powerful new rallies, with central banks and investors driving demand while the dollar weakens. Peter Schiff emphasizes that gold's record highs are not just a market trend but a warning of deeper economic issues tied to excessive money printing and debt. He argues that unlike Bitcoin, which he views as speculative hype, gold and silver remain true stores of value and the assets central banks themselves trust. For investors, the message is clear: follow the smart money into precious metals before the next breakout accelerates. Do you think gold's rally toward $3,500 will trigger broader recognition of it as the ultimate safe haven? With silver nearing $40, could this be the start of a long-awaited move into triple-digit prices? We'd love to hear your thoughts in the comments. If you found this video helpful, give it a thumbs up and subscribe for more updates. Thanks for joining us on this journey.
The U.S. government has moved to impose tariffs on deliverable gold bars, reversing previous expectations that bullion imports would remain exempt under President Trump's reciprocal tariff structure. A July 31st CBP, that's the tariff organization, letter reclassified the bars as, quote, semi-manufactured, making them subject to duties under code 7108.13.5500. This decision sparked a surge in New York gold futures, where December contracts traded over $125 above London spot before easing back into what you see there. Switzerland, the largest exporter of kilobars to the US, faces heightened trade pressures following a 39% country-specific tariff.
The US Customs and Border Protection ruled that 1 kilogram and 100-ounce gold bars from Switzerland fall under a tariff-bearing category, overturning prior expectations of exemption. This threatens Switzerland's position as a central refining hub and could disrupt global bullion markets, making them subject to tariffs ranging from 10% to 39%. This move disrupted the international gold market, with the London-New York price spread surging to over $100 per ounce compared to the usual 30 cents. A major gold refinery in Switzerland halted deliveries to the US following the CBP ruling. The change could fragment the global gold market, prompting buyers to shift toward non-Swiss bars at premiums. It also puts pressure on CME Group to address delivery issues for futures contracts. If upheld, the tariffs may reshape gold trade flows and force costly supply chain adjustments. Renowned market analyst Vince Lanci is known for his perceptive analysis of trading in commodities and precious metals. He discloses that certain huge gold bars, 1 kilogram and 100 ounces, are currently subject to tariffs from the United States. These bars are frequently used in EFP transactions as well as wholesale bullion trade. UBS is cautioning that the increased costs of these US taxes on massive gold bars may lead to a mass closeout of short exchange for physical positions, which could cause disruptions in the funding markets. The unwinding of these trades, which are typically settled in London, may complicate funding circumstances because it would create an unexpected demand for cash and liquidity in the city's bullion market. The apparent decision by the US Customs and Border Protection Agency, announced privately in a letter to a Swiss refiner on July 31st and made public on Friday, sent gold futures in New York soaring to a record, as insiders warned that the tariffs would have dire consequences for the market. Then, just as quickly, prices tumbled after the Trump administration suggested imports of gold bars wouldn't face tariffs after all. In the 12 months to June, Swiss exports of gold to the US were worth approximately $61.5 billion. Switzerland's rate is among the highest in the world, after Brazil, Syria, Laos, and Myanmar. According to reports, gold bars were in such high demand in the US in May following Trump's announcement of sweeping reciprocal tariffs the previous month that Costco capped the number of gold bars that could be purchased in a day. Let's jump into the video for more details. If you like what you see, please give us a thumbs up and subscribe to our channel to stay updated on our latest content.
Refiners in Asia have also paused shipments as uncertainty spreads. Industry experts warned the move could destabilize the gold futures market's pricing function, with UBS and BNP Paribas strategists questioning whether the ruling was an error or a fundamental policy change. To put a little bit of color on the mechanics of what is going on and why this is affecting the market the way it has, before giving you a very simple big picture overview. London deals mainly in 400-ounce bars. US contracts are for 1 kilogram or 100-ounce bars. During COVID, the problem that's happening right now also arose. When there is demand for US delivery, London bars are sent to Switzerland to be re-refined or refabricated into US formats. London has been the default physical hub for gold for decades, while the US has focused on making a more robust futures market. Dealers in London are typically long metal in their vaults in London and hedge by being short US futures through the EFP carry trade. They are long London gold, 400-ounce bars, and short U.S. gold, 100-ounce bars. If U.S. delivery is called, which historically is rare because the COMEX is a paper market, and everybody knows that you should want to get your metal from London, they would take the metal that they have, their 400-ounce bar, send it to Switzerland where the refineries are, have the Swiss break down the 400-ounce bar into 4 100-ounce bars, changing the format, satisfying U.S. rules. The new tariffs disrupt that trade. A London trader, long gold and short U.S. gold, long London gold and short U.S. gold, now faces a choice. First of all, London traders have been doing this for years. They're long the physical and they sell futures against it legitimately to carry the differential. It's kind of like lending money out. Gold is money. And they get comfortable doing that. And it gets to be a crowded trade. It gets to be a lopsided trade. And so they have these large legacy positions that they're always massaging. But when news like this comes out, and you can't take your 400-ounce bar and put it into 4 100-ounce bars to ship it to New York if someone ever wants the physical, you have a problem. You can find another refiner, not possible overnight. I wouldn't give you any. Squeeze the shit out of you, excuse me. You could do nothing and die a painful death, or you can buy back the U.S. contract quickly. So they're short the U.S. and they're long London. So they buy the U.S. contract quickly, and then they decide whether or not to sell the London contract. So it's a regulatory contract issue. If somebody in the U.S. were to say, "I want the gold," as we have been doing, well, then you would have to get the gold. The driving behind the price higher is this covering or this unwinding of the EFP, which is really just a spread between London and New York. This exposes the weak link in the triangle of trade. London. London acts as an intermediary, but problems in metals markets over the last 5 years, gold, silver, and nickel, for example, and copper, have been venue or fungibility problems. Again, very similar to what happened during COVID. Supply chains that are too long are being shortened. Now, to zoom out on a little bit of a big picture thing here, because this is all part and parcel of what's been going on over the last 3 years.
Vince points out that the conventional relationships between the US and London gold markets have been upset by this sudden action. There was a notable pricing disparity, as New York futures reached all-time highs, while London spot prices remained essentially unchanged. For example, London spot prices closed at $3,439.10 per ounce, while December gold futures hit $3,534.20 per ounce. The White House announced that it would issue an executive order to clarify its tariff position in response to market turbulence. The goal of this action is to clarify any confusion and establish stability in the bullion market. The current state of affairs underscores the intricate relationship between international commodity markets and trade policies. As the U.S. administration seeks to assert its stance on gold imports, the broader implications for the gold market and its participants remain to be seen. The White House's upcoming executive order should hopefully clear things up, said the logistics source. Protecting the U.S. gold futures during this uncertainty are high stocks of gold in COMEX-owned warehouses after massive inflows over December-March as traders hedged against the possibility of broad U.S. tariffs hitting bullion imports. The COMEX inventories currently amount to 86% of open interest, against a more normal 40 to 45%. So there is no liquidity issue at present, said StoneX analyst Rona.
Copper earlier, London spot prices were largely unaffected and are now lower. This reflects the weakest link in the triangular gold trade between London and the United States, as I just said. Moving on to the immediate potential effects. If the move is intentional, it is a game of chicken with the potential to disrupt the gold market at the financial side substantially. The negotiation is with Switzerland, but it highlights that Western gold's trade weak point is physical supply in London, while Western demand is increasingly in the US, pulling the gold over here. The supply chain must shorten. Because gold is also money, restricting its movement is weaponizing our payment chain. If unresolved quickly, this will push market participants into their own corners, taking their kickballs and going home, but more aggressively, make global trade more fragmented and bilateral, with every deal negotiated separately. If Trump meant to do this, he could still adjust course, as he recently did with copper, depending on the reaction. The Swiss have already offered, as we said, at least verbally, to consider moving refining capacity to the US. It is unclear how serious that is. If it was unintentional and the result of a classification error, or Trump just bluffing to see how they'd react, the decision could be reversed within days. For now, given the opportunity, this is effectively a coin flip. Traders might use this as a point to close positions, winning or losing, until there is clarity. The implications are significant, but the core story is here. Related posts. By the way, that full story is in Tariff Shock Triggers Historic Gold Market Location. The link is there. Related post. Last night we put it out. U.S. imposes tariffs on Swiss gold bars. Yesterday we also put out UBS raises the 2025 demand roof. Suspicious, no? Founder special, Fed death, gold industry coming to America, as we thought would happen. Swiss offer U.S. its gold industry and trade talks, and the must-watch report from yesterday. Okay. We have a little note here we just want to say. Isn't it interesting? I won't say the word suspicious, that within days of each other, the Fed weighs in on gold revaluation. The LBMA is exposed as a weak link while we're trying to repatriate our own gold supply industry. These things point to potential revaluation of gold. They definitely point to a deepening and a realization of the importance of gold in global trade going forward. They show the LBMA problems, and we need to secure our payment and supply chains for gold if we view it as an international asset that's needed. Other metals would follow. In 5 minutes, he could reverse this and say, I didn't mean it. And you could think that he's either screwed up or bluffed. And you'd say he's a dummy. Or, and this is equally true, Trump has a habit of, most government does, but Trump has a habit of shooting and then aiming. So perhaps he shot and aimed because he wanted to see how they can react. You know, when you're the incumbent, you get to make those mistakes. That's why Microsoft software sucks, because they can put it out and then fix it later on. Anyway.
This steep tariff on Swiss gold bars marks a significant escalation in U.S. trade policy, potentially reshaping global gold flows and driving up domestic prices. With high demand already evident, as seen in Costco's purchase limits, the new levy could further tighten supply and increase costs for American buyers. How might these tariffs impact gold prices in the U.S. over the next year? Could this lead to increased smuggling or alternative sourcing of gold? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.
Most of it is leaving the COMEX, which is also very unusual. It's not going into the eligible category in the COMEX, it's leaving. So it's called a loadout. We're seeing massive deliveries and a lot leaving. Who's doing this? Same thing is true here in the West, where 40 plus central banks have pulled their gold out of the New York Federal Reserve, which would for 50 years give access to COMEX, and pulled their gold out of the Bank of England, which would give access to the LBMA. So they're taking physical possession, removing counterparty risk. So anyways, we see all this gold being delivered. Say several things that are provocative or certainly interesting, and that is he's a self-proclaimed gold bug. He said things such as, I want to remonetize the asset side of the balance sheet for the U.S. government. Now, he backed off saying it's not gold, but I'm thinking he's going to remonetize gold.
Physical gold deliveries have increased significantly, according to recent COMEX statistics, with warehouse stockpiles dropping from 45.1 million ounces in early April 2025 to 43.6 million ounces by mid-April, a $4.8 billion decrease. 8 days in a row, traders have been repatriating metal, some of them back to London, as a result of the reduction of U.S. import tariffs on gold. This is the first such run in 14 months. Demand is being driven by trade disputes, slowdown fears, and global tensions. Persistent drops in COMEX stocks may indicate a physical scarcity and lead to a price increase. Treasury Secretary Scott Bessent stated on February 3, 2025, that the United States intends to monetize the asset side of its balance sheet in less than a year. Although a revaluation of gold is not currently being considered, expert Andy Scheckman thinks it might eventually entail remonetizing gold. Highlights that global trade tensions, particularly US-China tariff wars, have rattled markets. Gold, a classic safe haven asset, is seeing increased interest as investors hedge against economic instability. The Moody's downgrade of the U.S. credit rating in May 2025 further fueled this trend. China's gold market is heating up, with speculators and central banks boosting demand. Reports suggest Chinese investors are diversifying away from U.S. dollar assets, and physical gold is a prime beneficiary. Earlier this year, fears of U.S. tariffs on gold imports prompted traders to stockpile bullion in COMEX warehouses. Now, with some tariff exemptions like those for Switzerland, gold is flowing back out, tightening U.S. supplies. Moreover, China has moved forward independently, rebranding the project as BRICS Bridge. This new version is already fully connected with 11 Southeast Asian countries and 5 Middle Eastern nations, collectively representing 38% of global GDP. The 17th BRICS Summit held in Brazil's Rio de Janeiro has come to an end. The one big takeaway from the annual summit was that the leaders of the BRICS countries have decided to move forward on implementing a cross-border payment system, the main global interbank payment network. Gold remains central to the plan, signaling a shift toward a settlement system less dependent on the Western financial framework. We're about to explore the video, but first, subscribe and hit the bell icon to keep up with our newest uploads. Your feedback in the comments is always appreciated.
I think gold is becoming central to a new system. Call it the skeletal system of a new monetary order, whether it be in the BRICS or whether it be in the United States. Last year, the Bank of International Settlements pulled out of Project Enbridge at the 12th hour. They had been developing it with the Bank of International Settlements Innovation Hub with China, Hong Kong, Thailand, and the United Arab Emirates. And the Enbridge technology is a cross-border payment system that allows for instant settlement, 7 seconds, a 98% reduction in fees, cross-border between central bank digital currencies from country to country, free from SWIFT intervention. And the fifth participant in the Enbridge technology is Saudi Arabia. And things were progressing to the point where Dilma Rousseff, the former president of Brazil and the head of the New Development Bank, the BRICS New Development Bank, said, we've agreed in principle to a new settlement system called the unit. It is a digital representation of a basket of 60% BRICS plus currencies and 40% gold, deliverable upon request. And things were progressing. And you could see that gold was becoming central to their theme. And we've agreed upon it in principle, she said. We're ready to roll it out over Enbridge, which is operational. And at the 12th hour, in what amounts to espionage, James Bond movie, the BIS, which is a Western institution, pulled out and said, we're pulling the plug on Enbridge. We can't, and mind you, this is largely a Chinese technology, although through the Innovation Hub it was refined and thoughts of rolling it into the Western system as well. And they say we can't be involved in any platform that will allow countries to sidestep Western sanctions. And so they pulled out. Now it's as if they just realized that Russia was the R in BRICS. And then things went very quiet. Now, since then, we've seen some very, very significant things that I think are largely being ignored by the West. And in particular, the new Enbridge, let's call it repackaging, it's called BRICS Bridge. And BRICS Bridge has now been rolled out officially by China. And they're calling it the renminbi cross-border payment system, first and foremost. So what I believe is happening is because Trump is putting so much pressure on the BRICS, they're kind of stepping out for a second, maybe waiting him out and letting China take the lead in developing the rails of this new system. And China came out about 3 or 4 weeks ago and said, and I've talked a lot about this, that, hey, we have connected with the new bridge technology, fully connected and integrated, 11 Asian countries, ASEAN, these are the countries from Southeast Asia, and 5 Middle Eastern countries. This represents 38% of global GDP.
Russian Foreign Minister Sergei Lavrov confirmed that several initiatives are underway within the BRICS framework to develop alternative, independent payment platforms. Crucially, he stated that countries outside BRICS will also be able to access these systems once established. At the BRICS outreach session, there is an ongoing work to create a cross-border payment and settlement infrastructure. And he emphasized the drive to build a more stable global economic architecture, anchored in multipolarity, where trust in Western-dominated institutions is diminishing. BRICS countries, he noted, are positioning themselves as key drivers of this transformation. The Shanghai Gold Exchange, SGE, officially launched its first offshore, international board-certified gold delivery vault in Hong Kong, and he believes this marks a major milestone in facilitating RMB-denominated gold trading and attracting global investors seeking physical delivery in a stable jurisdiction. While the Hong Kong vault is now operational, no confirmed updates yet on vaults in Saudi Arabia, under construction, Moscow, St. Petersburg, Dubai, or elsewhere along the Belt and Road are publicly available. These remain future objectives in China's broader strategy to build a decentralized, resilient gold settlement infrastructure. The new Hong Kong vault, operated by Bank of China, Hong Kong, enables RMB-denominated gold trading with cash or physical settlement. Analysts see the launch, along with 2 yuan-denominated gold products, as a major step in Beijing and Hong Kong's push to expand global commodities trading and potentially erode Western monetary dominance. Let's revise the interview.
You had Sergei Lavrov, who was in meetings with Dilma Rousseff the year before, when they both came out of the meeting, said, we've agreed in principle to this new settlement system called the unit. He's been closely involved in all of the BRICS meetings since day one. And a lot of the technology or a lot of the ideas, the infrastructure of how they would roll things out were his. So in any case, he comes out and says, we're going to issue this BRICS technology, this cross-border payment system. We're going to issue it to non-BRICS members, not just the BRICS. A lot of the pushback with the BRICS has been they're not big enough. When he said that, after they had already connected the Asian countries, it became very obvious that this is bigger than people are thinking. And I said publicly they're going to roll it out to the Belt Road Initiative, which it appears they now are. So what I'm getting at is that this system, which would compete with the SWIFT, will settle in 7 seconds, not the 3 to 5 days it would take these countries to go back and forth from dollars, from their currency to dollars and the other currency, and back and forth at a 98% reduction in fees. And they're going to open it to the remainder of the world. It's just not compatible with the pound, the euro, or the dollar. Subsequently, BRICS Pay is also being rolled out to the Belt Road Initiative, which is 75% of human population, 50% of global GDP. This is the cross-border business to business, consumer to business, small bank to small bank, the retail side of BRICS's agenda. Again, China is doing the central bank side. They're calling it the renminbi cross-border payment system, but it is the BRICS bridge. It is the M-Bridge technology. But rather than antagonize the president, they're letting China do it first. The key to the third piece of this puzzle, the key to it all, at the same time, we get the expansion of the Shanghai Gold Exchange into multi-jurisdictional vaults around the Belt Road, starting with Hong Kong. The vault is complete. The next one is Saudi Arabia, which is under construction now. The idea between all of this is to allow countries to trade cross-border with one another in their own central bank digital currencies. We already have 16 countries officially signed up outside the BRICS, the Asian countries and the Middle Eastern countries, and to settle imbalances in gold through a series of multi-jurisdictional vaults, whether it be the expansion of the Shanghai Metals Exchange, Hong Kong, which is operational. And by the way, the yuan is immediately convertible into gold, not having to first convert to dollars as you would have in the past. So they're saying, okay, China will trade with Saudi Arabia. They'll send them digital yuan for their oil. Saudi Arabia can then immediately convert that into gold if they wish. Right now in Hong Kong, soon to be in their own country, in these vaults as they expand through the Belt Road, very ambitious endeavor, but ultimately connecting to a whole series of vaulting networks, whether it be in Moscow, in St. Petersburg, in Dubai, the new BRICS Gold Exchange, Shanghai, and the vaults that we see throughout the world. It enables these countries to trade locally in 7 seconds, boosting their own monetary infrastructure, free from SWIFT intervention, and settle any and all imbalances in gold. It's genius. It truly is. And I really hammered this home over the last month. And then yesterday we get an article, or 2 days ago, from Forbes that pointed out that China is now just the third largest trading partner for the United States. And in May, their numbers were less than 6% of trade, which is the lowest level, Daryl, in over 20 years. And the article went on to say that the Asian countries, these same countries that are now hooked up and actually in operation with the new bridge technology, together have a population twice as large as the United States, over 700 million people. They have the fastest growing consumer markets in the world, the fastest growing middle class in the world. And as a group, get this, these countries are now China's largest trading partner by far, way ahead of the EU and the United States. Let me just say that once again. They're connected, and they're the largest trading partner of China, and they can trade cross-border in 7 seconds with no SWIFT interference, no SWIFT recognition. They won't know what's going on, and any imbalances will be able to be settled immediately in gold. This is a massive deal for the BRICS. All right, so that more or less covers the BRICS side of things, where you have, in essence, an expansion of the Shanghai Metals Exchange connecting with other metals exchanges already in operation in Dubai and in Moscow, the new one that just was built in St. Petersburg. And the ambitious goal over the next year or two is to create this skeletal system of vaults, multi-jurisdictional, so it's not all held in one location like the Bank of England, who had the power to say to Venezuela, yeah, we're not going to give you your gold, thanks anyway, move along. So you want to be able to keep gold in various jurisdictions to mitigate any risk, and then be able to settle imbalances through trade through this entire network. It's important to remember that the Belt Road Initiative, these countries are not in the BRICS, nor is the Shanghai Cooperation Organization, the largest regional military and financial group in the world, or the Eurasian Economic Union, all the countries that end in STAN, a Russian endeavor like Kazakhstan. These countries are all very, very, very connected to the BRICS. In fact, the president of Belarus has been screaming forever that the Shanghai Cooperation Organization, the Eurasian Economic Union, should meld with BRICS. The Belt Road countries, 150 plus countries, 75% of human population, 50% of global GDP. They're not in the BRICS, but they are very connected with the BRICS.
A changing global financial order is indicated by rising physical gold demand, COMEX outflows, and strategic actions by China and BRICS. Gold is recovering its monetary significance as the United States deals with trade conflicts, credit downgrades, and possible balance sheet monetization. A shift towards settlement methods less dependent on the dollar and SWIFT is indicated by China's offshore gold infrastructure and BRICS-led payment systems. With gold at the center of a new trust-based economic structure, this multipolar movement has the potential to revolutionize international trade. Will the BRICS gold-based payment systems hasten the demise of the US dollar as the world's dominant currency? What effect would persistent COMEX gold outflows have on world gold prices over the upcoming year? Let us know your thoughts in the comments. If you enjoyed this video, give it a like and subscribe for more updates. Thanks for joining us on this journey.